Nancy was 57 when the letter arrived, 29 years as a registered nurse outside Boston. Her father had passed away in the fall of 2022 at age 79, and he had left her the traditional IRA he had built over 40 years as a mechanical engineer. $420,000 sitting in a brokerage account she had retitled as an inherited IRA and largely ignored. Her father had already been taking his required minimum distributions for years before he died, but nobody at the brokerage firm and nobody at her accountant's office had explained what that fact meant for her. She took no distributions in 2023, 2024, or 2025. Then in February of 2026, a letter arrived from the custodian informing her that the annual required minimum distribution she had missed in 2025 could trigger a 25% excise tax on the amount she should have withdrawn. Her penalty exposure was over $4,000. That was not her biggest problem. Her biggest problem was that she was standing in year 4 of a 10-year window she did not know she was in, with 6 years left to distribute the balance and a compressed tax schedule that would push 2 or 3 of those years into a federal bracket she had never paid before. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Nancy is not unusual. Nancy is what happens when an adult child inherits a parent's traditional IRA after 2019, nobody explains the rules, and 4 years pass before anyone notices that the most expensive clock in the tax code has been running quietly in the background. My name is Kevin Retires. Every week I break down the tax rules, the retirement traps, and the planning strategies that protect families from the mistakes nobody is warning them about. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. If you have been named as the beneficiary on a parent's individual retirement account, today's video is for you. And if a parent of yours has already passed away and you inherited their account in 2020, 2021, 2022, 2023, or later, this video is even more for you because you may be mid-window right now and not know it. Today, I'm going to walk you through exactly 3 things you must do before it is too late. First, determine whether your parent had already reached their required beginning date for their own distributions before they died, because that one fact determines everything else. Second, retitle the account correctly, because if you make the wrong move at the custodian, you can accidentally trigger full immediate taxation of the entire inherited balance. And third, build a 10-year distribution plan that avoids bracket spikes, protects your own future Medicare premium, and keeps the Internal Revenue Service from imposing a 25% excise tax on any shortfall. These are the 3 things Nancy did not know, and they are the 3 things most adult children of aging parents in this country do not know either. There are 3 specific scenarios I want to walk you through with exact numbers that will not fit in this video. I put them together in a written document I call the Retirement Tax Research. 1. The 42-year-old son who inherited $420,000 in a traditional IRA from a parent who was already taking required minimum distributions, showing the exact year-by-year distribution schedule that keeps him in the 22% bracket, instead of spiking into 32% in year 9 or 10. 2. The surviving spouse decision tree, the dollar-by-dollar comparison between a spousal rollover into her own account and keeping the inherited IRA separate, including the one scenario where keeping it separate actually wins. 3. The mid-window correction plan for a beneficiary who inherited in 2021 and has taken no annual distributions through 2025, showing exactly how to use Form 5329 to request the reduction from 25% down to 10% and rebuild a compliant distribution schedule for years 5 through 10, plus the full eligible designated beneficiary category breakdown, the Form 5329 walkthrough, and the complete action checklist for each year of the window. The link is in the description. First link. It is the Retirement Tax Research. Now back to the first thing Nancy should have done. The first thing you must do is determine whether your parent had already reached their required beginning date before they died. This is not a small detail. This is the single most important fact about your inherited account, and if you do not know the answer, your brokerage firm cannot tell you what your own obligations are. The required beginning date is April 1st of the year, after the account owner turns 73. For Americans born in 1960 or later, that age will rise to 75 starting in 2033 under the Secure Act 2.0. If your parent died before reaching that date, you, as a non-spouse beneficiary, have flexibility within the 10-year window. You can take 0 for 9 years and empty it all in year 10 if that is what makes tax sense. You can spread distributions evenly. You can accelerate in low-income years. The flexibility is yours. If you have made it this far, you're already paying closer attention to these rules than the average adult child of an aging parent in America. Before I continue, 3 things. Hit the like button. It helps this video reach other families in exactly the same situation Nancy was in. If you have a sibling or a cousin who also inherited from a grandparent, a parent, or an aunt in the last 5 years, send them this video today. And the complete retirement tax research is in the first link in the description. Now, let me show you what happens when your parent had already passed their required beginning date, because this is where most families get caught. If your parent had already reached their required beginning date before they died, meaning they had already started taking their own required minimum distributions, then your obligations are dramatically different. You must empty the account within 10 years, just like the other scenario, but you must also take an annual required distribution every single year in the years 1 through 9 of that window. These annual distributions are calculated using the Single Life Expectancy Table from Internal Revenue Service Publication 590B, based on your own age, not your parents' age. If you miss one of those annual distributions, as Nancy did, you're exposed to a 25% excise tax on the amount you should have withdrawn. That penalty can be reduced to 10% if you correct the failure and file Form 5329 within a 2-year correction window, but only if you act quickly. The Internal Revenue Service did grant a grace period. From 2021 through 2024, the service waived the penalty for missed annual distributions while the rules were being finalized. Many families and many accountants use those 4 years to avoid the uncomfortable annual conversation. But that grace period is over. Notice 2024-35 confirmed that 2024 was the last year for automatic relief. If you inherited a parent's IRA in 2020, 2021, 2022, or 2023, and your parent was already taking their own required minimum distributions before they died, and you took no distribution in 2025, you're now facing either a penalty or a correction process. The correction process is Form 5329, filed with your federal return with a written explanation of reasonable cause attached. If the service grants the reduction, your penalty drops to 10% of the missed amount. The second thing you must do is retitle the account correctly. This is where custodian errors cost families the most money, because the mistake is silent and irreversible. When a non-spouse beneficiary inherits a traditional IRA, the account cannot be rolled over into the beneficiary's own retirement account. That is not an option. It never was. If you as an adult child ask your brokerage firm to move your father's IRA into your own IRA, and the firm actually does it, you have just triggered a distribution of the entire balance in that year. The full $420,000, or whatever the balance is, becomes taxable income on your return for that year. At that income level, you're paying federal tax in the 32 or 35% bracket on the entire amount, plus state tax if your state tax is retirement income, plus a Medicare surcharge 2 years later when the look-back catches up. A single custodian error like that can cost a family over $150,000 in avoidable tax. The correct move is for the custodian to create a new account titled something like John Smith Deceased, IRA, for the benefit of Nancy Smith Beneficiary. That account stays separate from your own retirement accounts for the full 10-year window. A surviving spouse has different options, including a true rollover into their own account, but for every other type of beneficiary, the inherited IRA must stay in its own separate account titled in that specific format. Consider 2 adult children. Both inherit $300,000 traditional IRAs from a parent in the same year. Both parents were 78 and had been taking required minimum distributions for years. The first child, call him Michael, is 49, works in technology, earns $140,000 a year. He takes no distributions in the first 4 years because nobody explains the rule. Then in year 5, he reads an article, panics, and withdraws the full $300,000 all at once. That single distribution pushes his taxable income to $440,000. He pays federal tax at the 35% bracket on most of it. His state takes another 6%, and 2 years later his Medicare premium at age 60 jumps through IRMA Tier 4 because of that 1-year spike. Total tax cost of his panic move is roughly $126,000. The second child, call her Susan, is 49, same job, same income, but she gets competent advice in year 1. She takes her annual distribution every single year based on her single life expectancy, roughly $8,500 in year 1, scaling up as the balance grows. In year 9, she distributes the remaining balance, sized carefully to stay inside the 24% bracket. Her total tax cost over 10 years is roughly $72,000. Same inherited account, same starting balance, same income, $54,000 difference just in the sequencing of the distributions. That is a year of private college tuition. That is real money that nobody told Michael he was losing. There is one more category of beneficiary the tax code treats differently. The Eligible Designated Beneficiary category, created by the Secure Act, exempts 5 types of people from the 10-year rule. A surviving spouse, a minor child of the original owner, until they reach the age of majority, which is 21 under federal rules, a person who is disabled as defined by the Internal Revenue Service, A person who is chronically ill is defined by the service, and a non-spouse who is not more than 10 years younger than the original owner. If you fall into any of these categories, you can stretch distributions over your own life expectancy, the same way beneficiaries could before 2020. The siblings of the deceased, who are typically close in age, often qualify under the less than 10 years younger rule and do not realize they have this option. The third thing you must do is build a 10-year distribution plan that avoids bracket spikes and protects your own future Medicare premium. You start by calculating your first year required distribution using the Single Life Expectancy Table from Publication 590B. You look up your age in the year after the original owner's death, find the factor, and divide the account balance from the previous December 31st by that factor. That is your minimum for year 1. In year 2, you reduce the factor by 1. In year 3, you reduce it by 1 again, through year 9. In year 10, you distribute whatever remains. But the real planning work is deciding whether to distribute more than the minimum in years where your other income is low, so that you do not face a massive tax bill concentrated in the final years. If you retire at 62 with low earned income and a small pension, those are the years to accelerate distributions from the inherited IRA. If you are still working at peak income, those are the years to take the minimum. And if you plan to claim Social Security at 67 or 70, you need to project how the inherited distributions will interact with your provisional income calculation, because a large final year distribution can cause up to 85% of your Social Security to become taxable in the year you can least afford it. Here's your action checklist. 6 steps starting this week. Step 1. Locate the original death certificate of the parent and the final account statement from the custodian and confirm the exact year of death. This determines which calendar year counts as year 1 of the 10-year window. Step 2. Find out your parent's age at the time of death and whether they had already taken their first required distribution. If they were 73 or older at death and had filed at least one tax return showing an IRA distribution, they were past their required beginning date. If they died before turning 73, they were before their required beginning date. Step 3. Verify that the account is titled correctly at the custodian. The title must include both the deceased parent's name and your name as beneficiary. If the title looks wrong, call the custodian today and ask for a correction in writing. Step 4. If you missed any annual required distributions in 2025, download Form 5329 from internalrevenueservice.gov, calculate the shortfall, and prepare the written reasonable cause statement. File Form 5329 with your federal return for 2025. Step 5. Build a year-by-year distribution schedule for the remaining years of your window. Use the Single Life Expectancy Table from Publication 590B as your minimum, but plan actual distributions around your other income in each year. Step 6. Talk to a qualified tax professional who specifically understands Post-Secure Act inherited IRA rules. Ask specifically about the final regulations issued by the service in July 2024. Drop a comment and tell me, did you inherit a retirement account from a parent in the last 6 years? And did anyone explain the annual distribution requirement to you when you did? I read every single one, and the most common situations become future videos. Nancy filed Form 5329 with her 2025 return, wrote a brief reasonable cause statement explaining that her custodian never notified her of the annual distribution requirement, and requested the reduction to 10%. She built a 6-year distribution schedule for the remainder of her window and spread her makeup distributions across 2026 and 2027 to keep her income under the next bracket threshold. Her total remaining tax cost is higher than it would have been if she had started in 2023, but the difference is now measured in thousands, not tens of thousands. This is Kevin Retires. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more families who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. And if you know someone who has a parent with a traditional IRA, a 401k, or any tax-deferred retirement account, send them this video today. The difference between knowing these 3 things and not knowing them could be over $50,000 across a 10-year window. I will see you in the next one.